Every second, someone somewhere believes they're trading the market. But in reality, the market is trading them. You see a clean candlestick chart. They see liquidity pools, stop clusters, and predictable emotions. You see prices moving up and down. They see opportunity in your losses. This isn't a conspiracy. It's structure. It's systematic manipulation designed within the financial ecosystem itself. And tonight, you'll see how it truly happens in real time. Welcome to Rise from Zero, where we expose the institutional truths behind every candle, every move, and every illusion you've ever believed about the Forex market. Before we dive deep, I want to thank every single new subscriber joining this movement, and every loyal viewer who continues to rise with us. You are the reason we reveal what others refuse to explain. Stay with me until the end of this video, because what you'll learn tonight will forever change how you see the financial markets. If truth matters to you, if you're tired of being misled by illusions, subscribe now to Rise from Zero. Here, we don't chase trends. We chase the truth. For decades, traders have been taught to read charts. Support, resistance, indicators, patterns, all meant to simplify the market. But behind the scenes, banks, hedge funds, and institutions move billions through liquidity engineering. The truth? The market is not a fair playground. It's a battlefield designed to transfer wealth from the uninformed to the informed. And understanding real-time manipulation is the difference between being hunted and becoming the hunter. At Rise from Zero, we share facts, not theories. Every statement, every insight, and every example comes from documented institutional behavior, historical market data, and real trading patterns observed in live markets. So let's break down how manipulation truly works, not as a mystery, but as a mechanism. You're about to see the hidden layers of liquidity, deception, and control that define the modern financial market ecosystem. First, the institutional ecosystem. Banks, hedge funds, and liquidity providers form the core of the financial ecosystem. They don't trade like you. They trade through you. They don't use MetaTrader. They operate on interbank networks, using order flow data that retail traders never see. Their goal? Simple: collect liquidity. Every time you set a stop loss, place a buy limit, or open a position, you reveal your intent. And in a market driven by liquidity, your intent is the most valuable information. The market isn't random. It's structured. Institutions don't need to guess. They need to trigger. Second, the hidden role of liquidity. Every market move begins and ends with liquidity. Liquidity is where money changes hands, where stop losses sit and orders wait. When you see a sudden spike, it's not the market reacting. It's liquidity being collected. Price moves not because of demand or supply, but because institutions are filling large orders at precise liquidity levels. As a historical reference, look at the 1992 Black Wednesday collapse of the British pound. George Soros wasn't lucky. He understood where the liquidity and inefficiencies were trapped by central banks. He took advantage of it. A modern parallel can be seen when major news events drop, like FOMC or CPI. Price often spikes violently both ways before choosing a direction. That's not volatility. It's liquidity harvesting. Liquidity isn't the result of price movement. It creates price movement. Third, how banks move the market. Institutional traders don't think in patterns. They think in positions. When they need to buy, they can't just press buy. They must create sellers. So they push the price down to generate selling pressure. Retail traders panic sell, institutions buy into that liquidity, and then the market reverses. For example, look at major reversals in euro to US dollar or pound sterling to US dollar. Notice how price always takes out one side's liquidity before truly moving in the opposite direction. That's not coincidence, it's engineering. Institutions build positions while retail traders react to emotions. Fourth, the stop loss game. Your stop loss isn't protection. It's information. Institutions use algorithms that identify clusters of stops at obvious technical levels. These areas become liquidity targets. When the price wicks into your stop before reversing, that's not bad luck. It's data collection in action. For historical context, JP Morgan's trading desk has been fined multiple times for spoofing, placing false orders to manipulate price perception. The same concept exists in the FX market, only smarter, faster, and harder to detect. Stop hunting isn't a myth. It's a business model. Fifth, real-time manipulation in action. Let's observe a real example. During high-impact events, say non-farm payroll, price will often spike violently, hit liquidity on both sides, and then settle into the true institutional direction. What happens in those 3 to 5 minutes? Algorithms sweep liquidity, fill institutional orders, and remove retail participants. As a modern case study, look at the 2023 US dollars per JPY flash rally. Retail traders saw momentum. Institutions saw liquidity imbalance. Once they collected enough buy stops, they reversed the move, trapping thousands of traders. Every spike tells a story, but not the one you're taught to believe. If this content opens your eyes, remember, truth has power only when shared. Like this video, subscribe to Rise from Zero, and share it with someone who still believes the market is random. Sixth, the psychological trap. Markets don't just manipulate price, they manipulate belief. The more you believe in textbook setups, the easier you are to read. The more you trade on emotion, the easier you are to trap. Institutional traders rely on one thing above all: the predictability of human behavior. Fear, greed, impatience. Every candle on your chart is a reflection of mass psychology being exploited in real time. To beat manipulation, you must detach from illusion, not react to it. For example, firms like Citadel, Jump Trading, and XTX Markets dominate liquidity provision. Their algorithms react to liquidity in milliseconds, creating artificial volatility to fill orders and rebalance flow. The enemy isn't a broker. It's the system's design, speed, data, and liquidity dominance. Eighth, how to rise from zero. To survive, you must trade differently. Understand structure. Track liquidity. Think like an institution, not like a participant. This means mastering patience, top-down analysis, and liquidity mapping. Trading becomes less about prediction and more about observation. The less you chase, the more you understand. The moment you stop reacting, you start controlling. Today, you've seen the truth behind the illusion. Real-time market manipulation isn't theory, it's the architecture of modern finance. It's how money flows. It's how institutions manage risk. It's how traders are separated from their capital daily. But now you know the structure, and knowledge changes everything. Thank you to every subscriber, new and returning, who watched until the end. You are not average traders. You are truth seekers. And here, at Rise from Zero, you're part of a growing movement of minds refusing to be manipulated. Subscribe, share this message, and turn on notifications. Because every week, we uncover the institutional mechanics that move the markets, the same truths the world's largest traders use daily. At Rise from Zero, we don't chase illusions. We chase truth, results, and financial freedom. Remember, the next generation of traders will not be defined by luck, but by understanding. And understanding begins here, with truth. You were never meant to stay trapped in deception. You were meant to rise. And you will, from zero.